What is transpiring in the marketplace? Downsizing is transpiring. Retailers are downsizing their formats in order to achieve additional efficiencies from each store, higher sales per square foot, and to reduce occupancy costs. Walmart has gone from 200,000 square feet to 185,000 square feet. Staples is headed from 24,000 down to 18,000, and Best Buy is going from 40 to 30,000 square feet. Next, we have the Grade A shift. Not all the properties in the marketplace are immune to the bankruptcy bug and/or store closings, and Grade A properties are no different. As a result, tenants in B and C class properties now have the opportunity to move to an A class property. Why are they leaving the existing locations? They're looking for superior anchor adjacencies, better tenant mix, more traffic flow, and increased sales, which are derived from relocation to a Class A or Grade A property. If you own B or C class real estate, your property has become extraordinarily substitutable and extremely vulnerable. Rents have compressed. B and C class rents have decreased 15 to 30% over the last year. Tenants are often demanding rent reductions, some only offering percentage rents as an alternative. Grade A properties are not seeing escalation in value, but because of what? The Grade A shift, they are tending to maintain their value. And as a result, rents are staying at 90 to 95% of previous highs. What about cash? What about capital? Capital available for retailers to expand, to use for lines of credit for inventory, or for developers to build is virtually non-existent. As we know, good retailers and developers went bankrupt as credit sources evaporated overnight. The franchise operators are stymied by the financing process, and many are on the sidelines. National tenants are looking to conserve capital whenever possible and requiring landlords to turnkey finishes. Possibly the biggest story of the year is land. Land values skyrocketed over the last decade. Huge portfolios were accumulated, zoned, and prepared for shopping center development. As the markets retrenched, retailers curtailed expansion, demand diminished to a minuscule level. According to the CTMT Research Department, big box development has stopped in Indiana. We cannot find a Walmart, Target, Meijer, Home Depot, Lowe's, Menards, Kohl's, or JCPenney under construction. Now, these were the tenants that drove the engine expansion for the last 20 years. As a result, larger tracts of ground go unwanted, and developers of owners of these larger tracts, which have debt on their property, are merely the temporary custodians of the deed. We know firsthand property owners which offered big box retailers quality sites in growth areas zoned with utilities, free land, only to hear, we cannot make the numbers work. No, you heard me correctly, free land. Schedule F, free, denied. The numbers did not pencil, even with donated dirt. Conclusion, if you have the opportunity to sell your land, close the transaction. What about stocks? Retail and REIT stocks? Well, Starbucks was up at $40 a share and fell to $7. It's returned to $23. Duke Realty is up 300% from the lows of March 2009. Simon Property Group and Old National Bank have either raised dollars in the debt market or have issued additional shares. Dollar General, as we previously mentioned, and Rue 21 issued stock in the fourth quarter of 2009. And there's additional good news to report from downtown Indianapolis. Downtown Indianapolis continues to grow with White Lodging's $450 million investment into Marriott Place Indianapolis, a combination of 5 connected hotels totaling over 2,200 rooms and 145,000 square feet of meeting space. Hotels include the Spring Hill Suites, the Fairfield, Marriott Courtyard, the existing Marriott, and the new 34-story JW Marriott you see behind me. The JW will have 1,005 rooms, 20,000 square feet of exhibit space, 23,000 square feet of breakout space, a junior ballroom of 20,000 square feet, and the Grand Majestic Ballroom of 40,500 square feet, which will be the largest ballroom in Indiana and the Midwest. The Marriott Place Indianapolis project is currently the largest hotel complex under construction in the United States. When construction is complete, the Marriott Place Indianapolis and the expanded Indianapolis Convention Center will include over 1 million square feet of exhibit and meeting space, the combination becoming the 16th largest in the United States. Indianapolis will truly have one of the premier convention facilities with over 7,000 hotel rooms in walking distance. Don Welsh, president of Indianapolis Convention and Visitors Association, calls the Marriott Place Indianapolis and Convention Center expansion a true game changer. In addition, downtown activity has remained brisk as 19 restaurants opened during 2009. Included is Ambrosia, a longtime Broadable favorite, Iozzo's, Panera Bread, and Tastings Wine Bar, just to mention a few. Downtown Indianapolis continues to be a clean, safe, and inviting environment to live, work, shop, dine, entertain, and to hold your next business convention. Well, it's now time for the crystal ball. Predictions for 2010. Healthy REITs will grow via acquisition. Foreclosures of all types will accelerate. Weak retailers will declare bankruptcy as capital runs dry. Land will remain more dangerous than kryptonite to Superman. And for most retailers, 2010 will be similar to 2009, or until we see significant gains in unemployment. Just remember, 2011 is only 345 days away.